For decades, the global financial system has been able to solve almost every single problem the same way. You could call it fiscal magic. What do? Lower interest rates, more debt, more money creation. I mean, every single time the economy slowed down, central banks stepped in with another rescue package. Governments borrowed more, corporations borrowed more, individuals borrowed more. And all that cheap new money pushed stock and real estate markets higher and higher as the currencies lost value. And as asset prices rose, people believed the system was under control. Look at this. The system is okay. They have control. So at first, you could kind of say that magic worked. Story called The Sorcerer's Apprentice. And the apprentice discovers powerful magic that can make life easier. And the magic solves problems at first, but eventually the apprentice loses control of the forces he unleashed. For every single attempt to stop the problem, it only made it worse. And I'm sorry to tell you, maybe even happy to tell you this, I don't know. But that's where we are today. The modern financial system is dependent on debt creation to sustain the appearance of growth. As interest rates fell, it was easier to take on and service more and more debt. But now, interest rates are rising at the same time that debt levels are exploding. And so much of that debt needs to be rolled over into that higher interest rate environment. And that combination creates a mathematical trap. Today, I want to walk you through why this happened, why central banks are trapped, and why inflation is so sticky and purchasing power is frankly collapsing, and why gold and silver are beginning to reemerge as monetary assets. They really never went away. They were just hidden, not so hidden anymore. So let's start with the bond market that's signaling stress, because the 30-year Treasury yield reached the highest levels not seen since 2007. This is important because the bond market is the foundation of the entire financial system. And what was happening in 2007? Well, the great financial crisis was actually unfolding, but was not yet apparent to most and the public. And those higher rates, well, they were telling the world that the magic was losing its power. Higher long-term rates mean that investors are nervous about the future and are demanding more interest for taking that higher risk. Although it doesn't make a lot of sense to me to jeopardize your principal for itty-bitty bit of interest in currencies that are devaluing. But okay, we'll talk more about that later. Because frankly, the more expensive it is to borrow, the less new spending will happen into the real economy. Slowing income growth, it's really inflation, so much of it that they call growth, job creation and spending, and rising stress right across governments, corporations. For years, markets became used to lower and lower rates. But that changed in 22 when surging inflation forced global central bankers to raise rates. That broke that 40-year trend. That's a big deal. So do you think maybe that was when the sorcerer realized that their magic wand may be broken? Is this when it becomes apparent to the public? Today? When do you even want to know what's happening? When do you want to be prepared and ready for what's happening? And this is not happening just in the United States. This is a global issue. Japan, the UK, Europe, and the United States are all seeing rising yields at the same time. And that matters because the entire world became dependent on cheap debt, particularly after 2008 with quantitative easing and blah, blah, blah. But the global economy was built on the assumption that rates would stay low forever. Inflation changed those rules because there's only one way to fight inflation, and that's with deflation. So those higher rates need to cause that deflation. And now central banks are trying to fight inflation while sitting on top of the largest debt bubble in history. Technically, the breakout in yields is becoming very, very difficult to ignore. And across the yield curve, rates are breaking out together. 2-year, 10-year, 30-year yields all are breaking out. Technically, this is another pattern shift, and it matters because this tells us that the market is repricing risk right across the entire system. And that debt that was unpayable when rates were at or near zero, well, what do you think it is now? Because when rates rise on massive debt loads and they need to create more debt to roll that debt over, well, that math changes very, very quickly. And this is where the story begins shifting from an economic slowdown to a structural problem. This chart shows total debt across all sectors. Notice what happened after 2008. The solution to the last debt crisis, to every debt crisis, was even more debt. Governments borrowed more, corporations borrowed more, consumers borrowed more, central banks created more of that debt money liquidity. The system survived by continuously expanding debt faster than growth. That kind of worked while rates stayed near zero. Think about yourself, right? If you go out and you get a credit card and you spend money on that credit card, well, even as you're paying the interest on that debt, if you're not paying all of the interest every month, that goes into the principal and it grows exponentially. And that's in a lower rate environment. But now, with the rates that are rising into the largest debt structure ever created, and those breakouts tell me as a technician, you're going to keep going up. Sovereign debt sits at the center of that structure, since it's the full faith and credit of the government all around the world, the governments all around the world, that keeps this game going. The full faith and credit, let me just define that before we move forward. As long as you trust the government, you will continue to loan them money. That's what full faith and credit means. And look at this, because federal debt has gone vertical. Governments became dependent on borrowing to fund deficits, stimulus, bailouts, wars, and entitlement programs. But debt itself, frankly, that's not really the problem. The problem is the cost of servicing the debt, because when rates rise, interest expense rise exponentially. And this is where the Apprentice really does begin losing full control of the magic. And it's not only governments. Corporations also became addicted to cheap money. Businesses borrowed heavily because low rates encouraged that leverage, that borrowing. And what did that debt fund? Stock buybacks, acquisitions, expansions, and dare I say it, speculation. But higher rates now increase financing and refinancing costs across the corporate world and the government world, and individuals as well. This means less investment, slower growth, layoffs, like we are seeing, and weaker profits. Now, we're not seeing the weaker profits yet because inflation helps the corporations. And whether you're a corporation or a consumer, America followed the same pattern. Consumers increasingly relied on debt to maintain their living standards. That was the plan all along. Credit cards, auto loans, student loans, personal debt, all expanded rapidly. Why? Because the purchasing power was already weakening beneath the surface. And debt became a substitute for that real wage growth. Nominal wage growth. We'll see this in a second. Yeah, that was there. But the real wage growth because of inflation was not. And this is important because the system needed consumers borrowing to keep economic growth alive and corporate profits alive. And at the same time, central banks massively expanded their own balance sheets. Now, we've talked about this Fed pivot before, but frankly, since 2008, central banks stepped in repeatedly to stabilize markets. Every attempt to reduce central bank balance sheets has met failure because you cannot fix a too much debt problem with, dare I say it, even more debt. Yet, after every crisis, more new debt money, lower rates to generate inflation, more intervention, more lies. The magic solved problems temporarily and created other problems. But each rescue required even larger and larger rescues later. It's like pushing on a string. Think about the $800 billion that they did in 2008 and the $7 trillion they did in 2020. The financial system became dependent on continuous intervention. And while the Fed was trying to reduce its balance sheet, well, there you go. Just look at the inevitable reversal. Who didn't know this was coming? It's happened every single time. More debt is the only answer. But there's a big problem with that because while debt expanded, the purchasing power of the currency falls. Every single time the governments print new money, the value of all the money out there goes away, ultimately going to, my $10 trillion Zimbabwe note. And what does that do? Well, that creates a conundrum for central banks because this chart actually tells the real story. The purchasing power of the dollar has been steadily collapsing. This is just going back to 10 years, right? Can you see how steadily that dollar is collapsing? And by the way, look at those new numbers. In April 2026, we fell below 3 cents, according to the Federal Reserve. Inflation is not just rising prices. Inflation means that you are paid less and less for your labor over time. And debt, well, that's what's substituted for real wage growth to try and maintain that standard of living. Just think about this for a minute. 1971, the average wage was $10,500 and a family of 4 could live with one wage earner. Today, the average wage is almost $75,000, more than 7 times. But today, it takes 2 wage earners to support a family of 4, and they're still living paycheck to paycheck and can't pull $400 together in case of an emergency. So people feel this every day when they go to buy groceries or insurance or housing or healthcare or energy or on and on and on. The system tried to create growth through debt expansion and money creation, and that works for a while. But over time, inflation robs that debt money of all perceived value. It costs nothing to create this stuff. And now higher interest rates are colliding with the debt structure itself. This chart may be one of the most important in the entire presentation Federal interest payments are exploding. Think about what this means. The government now has to borrow increasing amounts of money simply to pay interest on existing debt. At some point, interest expense crowds out productive investment, savings, infrastructure, and economic growth. The debt begins feeding on itself. And this leads to the core mathematical problem. Because when debt levels become extreme, interest rates become systemically destabilizing. Low rates help create the debt bubble. Woohoo! Happy days are here again. But higher rates threaten the solvency of the debt structure itself. And this creates a trap. If central banks lower rates, inflation accelerates. If they raise rates, the debt system destabilizes. This is the moment when the apprentice realizes the broom no longer obeys commands. And this is the full doom loop. Increasing debt requires lower rates. Lower rates fuel inflation. Inflation forces higher rates. Higher rates explode interest expense. And that requires even more debt creation. Eventually, confidence in the currency begins breaking down. This is not a normal business cycle. This is the structural end stage of a debt-based monetary system. Historically, every fiat currency eventually enters this loop. And when confidence in currency system weakens and goes away, markets begin searching for monetary alternatives. Silver is beginning to reflect that growing monetary stress because it's both an industrial metal as well as a monetary metal. And that makes it extremely sensitive to systemic instability. Notice how strong silver remains even with higher rates. Markets are beginning to anticipate larger monetary problems ahead. That silver's the fuse, that's what it's telling us. But frankly, silver's role goes far beyond any price action in the contract because silver sits at the center of industry, technology, energy transition systems, medicine, monetary history, on and on and on. And there is far less physical silver available than most people realize because it gets used up in industry. And in periods of monetary stress, silver often becomes highly volatile because industrial demand collides with monetary demand. And that is why I call silver the fuse. It reflects pressure building inside the system, kind of like a canary in a coal mine. But gold plays a different role. Gold is behaving very differently from most financial assets. Despite rising rates and tightening conditions, gold remains historically strong. Why? Well, because gold is not someone else's liability. It is the only financial asset that runs zero counterparty risk. And it survived empires, currency failures, wars, and monetary resets. As confidence weakens in debt-based systems, gold begins reasserting itself as a monetary asset, which is what we've been watching. And that brings us to the larger historical picture, because gold has served as money and a store of value for thousands of years, not because a government said so, but because trust accumulated around it over centuries. Debt-based systems eventually reach limits because debt compounds mathematically. Duh. But gold does not depend on promises or leverage or central bank policy. It anchors value outside the financial system itself. And so, for decades, the global financial system solved problems the same way: more debt, lower interest rates, and more money creation. And at first, the strategy appeared successful. Markets rose, asset prices expanded, they went up. Debt-fueled growth had postponed pain. But over time, the system became trapped by the very tools used to sustain it. This is why we're at the end of this currency's life cycle. Now central banks face an impossible choice. It's an impossible choice because if they keep rates high, the debt structure becomes increasingly unstable because interest expense compounds faster than economic growth. And you just saw the breakout in all right across the spectrum of yields. That means they're more likely to go higher. But if they lower the rates to create more liquidity, they risk accelerating inflation and weakening confidence further in the currency itself. And this is a Ponzi scheme. It requires confidence. And we just saw that confidence from the consumer fall to the lowest that it's ever been since tracking began in 1952. That is the debt money doom loop. And throughout history, when debt-based monetary systems reach these kinds of extremes, societies eventually, they move back towards sound money and tangible assets, hard assets, not because of fear, but because confidence in paper promises began breaking down and they saw it. So like the Sorcerer's Apprentice, policymakers use financial magic to delay economic reality. But eventually, the magic stopped obeying commands. At Zang International, our sound money strategy is built around a simple principle that history repeats or at least rhymes. And so when confidence in debt-based systems weakens, preserving purchasing power becomes more important than chasing returns. That means focusing on sound money, tangible assets, and food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. We are getting so many warning signals, and I can't tell you that you will lose all choice by Tuesday morning at 8:35, but you might. So get ready today. Call us. We will help you figure out how much gold and silver do I need? What kind of gold and silver do I need? Because frankly, there's gold and then there's gold, and there's silver and then there's silver. You want to hold real wealth outside of the financial system. Then that keeps you alive to play another day because it preserves your principal. If you lose all your principal, what do you have to work with? And positioning before the broader public recognizes that the structural shift is taking place, it's what you want to do. Because gold anchors the wealth, protects your purchasing power. It's why they make cryptocurrencies look like gold, silver, and platinum. That's where they want you to go, because that just gives them more free rein. But both gold and silver have served as monetary assets for thousands of years through every major currency reset in history, over 4,800 of them. And our sound money strategy is based on that history and supports sustaining a reasonable standard of living, provides proper and real portfolio diversification with tangible sound money that you hold and you own. And it all starts with your goals. You know what our goal is on this channel? To translate financial noise into understandable language so that you can make educated choices that, I don't know, what a concept, puts your best interest first. I'm hoping to help you look at things just a teeny bit differently, because when you do, whoa, it is amazing what you see. And you know, I've studied currency life cycles and currencies since 1987. There is absolutely no doubt that we are entering a new monetary regime. When one system dies, another one is born. Gold and silver is the bridge to get your purchasing power from one system into the next. Go to a farmer's market. Build your local community. Get to know who grows your food. Volunteer. Learn a new skill. Create that local community because there's safety in numbers. There's power in those numbers. There's freedom in those numbers and in gold and in silver. And globally, to get redeemable gold back in the global monetary system. And that means if you don't like what you're seeing, give me my gold back. You now have the power of the purse. The public must take its power back, or we will get something that none of us are going to like, except for those at the top. I know we can do this together. There isn't one doubt in my mind that we can make this quiet and peaceful revolution happen just by converting your garbage fiat into sound money. And until next we meet, wherever you are in this world, please be safe out there. Bye-bye.